Are you paying the right fees for the financial advice you are receiving? Joining us on today's coffee break is Tom Popielarczyk to discuss. Tom, what are the different fee structures available to investors and what are the main differences?
The main fee structures are the traditional commission model and the fee-based model, which is relatively new, but it's been around for quite a while. Under the fee-based model, the client pays a fixed fee based on the amount of assets under management, whereas the commission model gets a bit murkier because there's different investments that have different compensation structures and can cost or not cost to buy and sell.
What are some of the conflicts? What are some of the conflicts of interest that may arise from one fee structure over the other?
Part of why we prefer the fee-based model is that it virtually eliminates conflict of interest. It aligns interests between the advisor and the client in such a way that for the advisor to get a raise, their portfolio has to grow.
Well, that makes sense.
Clients tend to like it.
Yes, I can see why. How about on the commission-based?
Well, the commission, again, like everything else in life, it gets a bit murky. Generally, advisors are extremely honest and full of integrity, but when there's a payment to execute a transaction, it can be very challenging in terms of knowing with complete certainty it's in the client's best interest.
Right, so just a fee-based model eliminates even that perceived conflict or that doubt. Now, a transactional-based, commission-based account may be suitable in some cases, though. Can you think of an example where that method might be preferred?
Absolutely, and that's a great question. In some cases, people want to manage their own investments and they're better off simply going to a discount brokerage. If they want tax and estate planning and financial plans created for them and some of those additional value-added services, well, then they're going to want to use a financial advisor. And in that case, you have to work out a compensation structure that works for everybody. But again, I emphasize for people who have no interest in that sort of thing and are confident making their own investment decisions, they probably should go to a fee-based, or I'm sorry, to a discount broker.
Yeah, assuming they really do know what they're talking about. I know sometimes it's easy to get information on the internet, but you don't know what you don't know. And that's what scares me a little bit. So final question, when it comes to fees, and if a client or an investor is looking at a fee-based approach, what do they need to consider to make sure that the fee they are paying is reasonable for them?
That's a great question, Sybil, because not all fee-based accounts are created equally. When interviewing prospective advisors, and I would recommend they interview at least 3, ask them what the total cost of investing is going to be, and then ask them to compare it to what they're currently paying, and most importantly, confirm what services are available for that cost. And once you get that information, you can compare it to the services you've been receiving. And while not the be all and end all, these are very, very important components of making this decision.
That's great advice. Thank you so much. And viewers, if you enjoyed this and want to learn how to make smarter financial decisions, go to thewealthylife.com. And that's our coffee break. See you next time.